speaker today is Larry Gaines. Now, Larry is the founder of Power Cycle Trading and has over 30 years of experience trading and investing billions of dollars worth of oil, foreign exchange, financial market derivatives. His passion is options trading, and since 2009, his focus has been on the development of a low-risk price cycle trading system that is very effective, achieving higher profit margins with smaller capital investment. And in today's presentation, he's going to be talking about an option strategy for uncertain markets. And I think we can agree we're in uncertain markets. And he's going to be covering why using the option butterfly strategy works so well in today's markets, the 4 major benefits of using butterflies to generate low risk income, and the butterfly setup and the most important factor to focus on that he actually uses actively in his trading. And so with that, folks, let's welcome Larry Gaines to the room.
Well, thank you so much, Raleigh. Appreciate
Oh,
you having me here today.
Oh, we're delighted to have you here, Larry. When you're ready, you can just grab the screen and run with it.
Let me see if I can get this rolling here. Okay. Now, can everybody see me?
Absolutely.
Or see my screen?
See your screen, and we hear you loud and clear.
Let me just make sure I've got everything lined up the way I want it. 1 second here. One second.
Yeah, no problem.
I was just trying to open my chat box here real quick.
Okay.
Oh, here we go. Okay. And we're good to go. Let me just move this a little bit. All right. All right. Well, again, thanks for having me here today. And yeah, we are in some uncertain markets. You know, it's just, it's always a headline in the markets, one way or the other, driving the market price up or down. So, but in this market, you know, we've got a lot of different things tugging on the markets for price action. So what I'm going to talk about here is 2 really great option strategies for uncertain markets and high volatility markets. And those are the butterfly and the long condor. So let's get rolling. So the following webinar here today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So what are the secret to trading profits? For me, it comes down to 3 things: direction, timing, and then good risk management. And with risk management, that's where we come into using options and various option strategies. So when we're trading options, it has so many more advantages than just trading stocks. But as you probably know, it's a bit more complicated as well. But once you understand the benefits and the advantages of options and option spreads, you're really never going to look back. So when used correctly, option spreads are going to provide you really defined trading risks. They can really lower your capital at risk, provide you greater trading leverage, and offers an unmatched hedging advantage. And so the beauty of options too is really the hedging benefits that you get. And that's what we're going to look at today as well, the great hedging benefits that we will get from the butterfly and long condor. Now, what if you had a trading strategy that could literally turn around losing trades and maybe even turn them into winners? And what if this same strategy could capitalize on the 2 main option pricing components, time decay and volatility, more so than any other method? So would this be worth your time to learn it? Now, over my 30 plus years of trading, I've found that the most valuable go-to option strategies that can help literally any trader more than any other trading strategies known are the butterfly and the long condor option spreads. Now, the huge advantage of these strategies are their unique option framework that's going to allow you to construct trades that will provide more consistent and greater returns in any type of trading environment, and especially in high volatility, uncertain markets due to their simple but very dynamic structure. And because they're structured to require only a small amount of your hard-earned capital, your trading returns are going to be greater and your trading stress is going to be really reduced. And to me, that's a really win-win situation. Now, the butterflies and long condors are very dynamic and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade the butterflies and long condor, and you're going to be able to be covered for both your offense and defense. So your goals, protection, or profits and hedging. Now, these types of strategies, they can work no matter what the markets are doing. You could have an uptrend, a downtrend, or a sideways market. They can provide you income from stocks that are going nowhere, eliminates the stress of having to be perfect on a stock's direction or overall market, eliminates the time decay expense that's encountered from decay in long options, takes this unsettling guesswork out of your trading, and these can be structured at a very low cost or low capital at risk. And that's the thing that I like about it. So you're going to see a lot of examples here today of how low you can get your risk, but the rewards are fantastic. So you can literally get 10 to 1 or higher reward to your risk that you're putting up on a trade. Now, when we look at the butterflies and long condors, they're very dynamic and they can be traded for a variety of different reasons with different goals. So in other words, once you learn how to trade the butterfly and the long condor, you're going to be covered for your offense and defense in goals and protection. Now, butterflies and condors are flexible, as you're going to see. And once you learn the fundamental setup, you can adapt these option strategies for both your goals and your market insights. So you can structure them to be more delta neutral, where you don't have to be exact on direction. But to me, the real beauty is that they can be used for directional trades, offering you either a bullish or bearish exposure to the market when you feel pretty sure a stock is going to be going in one way or the other. But the thing is, if you're wrong, by using a butterfly long condor, it's going to really help you to manage your risk and at the same time retain large potential returns. So you can structure these things based on what we call the spread width to be very low risk, or wider to make it higher risk, which makes it potentially bigger win for your profits. So the structures are very dynamic, and we're going to go through a lot of examples here today so you can see that. Now, let's be real though, these types of spreads will not offer you the unlimited profit potential, but like say, for example, you just go long a call, but they're going to usually cost you a lot less than just buying the outright options, and they're going to offer you an amazing risk to reward trade setup. So this means that the butterflies and long condors can significantly increase the probability of your winning trades while also reducing your risk. And that's really what it's all about in trading. Now, when we look at the butterflies and long condors, they can also be used for hedging. So, when you mess things up, this is what I like to go to. When the markets start to get kind of confusing and you need to hedge and reduce your risk, this is the strategy I use. So they could become like a really fast, low-cost way to cover what pronto when a position starts moving against you. And I've literally found no other hedging strategy that even comes close to incorporating these two strategies as a hedge on your trades that you have set up. Now, by constructing either the butterfly or long condor around a strike that's under pressure from, say, another core trade setup, such, let's say you do credit spreads or you do debit spreads. So by performing or constructing a butterfly or condor around that original core trade, this is what I found to be the best way to immediately neutralize and reduce and control that risk of your original trade. So what you can do is you can literally keep the original position open by just implementing either a butterfly or long condor hedge around that original position. And what this does is the butterfly and the condor, they take advantage of it's made up of two different spreads, a long spread and a short spread. So the short spread is going to take advantage of theta decay or time decay. So that's the beauty of it. So you can hedge using this butterfly strategy to take advantage of time decay while you wait. And a lot of times, you put on a trade and it starts to go, looks really good at first, and then it stalls out and maybe starts to move against you. And so you're kind of left there puzzled as to what to do. You can either stop yourself out, and if you stop yourself out, how many times have you seen it come right back? But what I've found is by doing or implementing this kind of hedge structure against your original core trade, what it can do is it can buy you time for that trade to settle down, stabilize, and at the time you're getting paid because you're taking advantage of that time decay component. So a lot of times it's just a little bit more time you need on that original position to stabilize it, moves back in your favor. At that point, then you can remove the hedge and stick with your original trade, writing it for what it's worth. So you've got a lot of different options when you do these types of hedging kind of constructions. Now, here's a typical butterfly setup construction. And if I can get the tool to work here, I'll show you. So basically, this would be like a call debit spread. So, you're long a call and you're short a call. So your total risk here would be $300. That's your debit paid. But what I like to do is never never lose your total capital at risk. So what I would do is, control that risk. You might stop it out. But another thing you could do is you could convert this to a butterfly. So let's take a look. How would you do that? Let me put this back. Okay, so we can convert it to butterfly. And all we need to do is sell the same short strike, and we convert it to butterfly by creating a bear call credit spread against the debit spread. So we would sell a call here, short call, and buy a call here. And this is going to bring in a credit of $200. Now, when we combine that with the original call debit spread, we've created this butterfly structure. So this is what we call a balanced butterfly. So you can do this with calls or puts. But what we've done is we've gone from a $300 capital at risk to $100 at risk. And we still have what we call a really good profit zone in here. This is called the profit tent. So at expiration, if it goes outside or inside, expires inside this tent, you've got a potential for, fantastic return on that reduced capital at risk. And so this is where you really get these high returns on your risk. Now, when we look at the long condor, it's very similar to the butterfly. But the thing that I like about it, we can spread this short strike out more than having it strictly at the same strike price as the debit spread of either if you use calls or puts. And by doing this, we're going to increase and make a bigger profit zone. So it can separate this out, spread it out, makes us a bigger profit zone. And then we've got a bigger zone to work with for our profits. Let me see if I can get this thing to work here again. All right. Well, I'll just go back to the mouse here. All right, so that's the thing that I like about the condor. So we'll go through some examples here so you can see exactly how these structures work. Now, the core concept that makes the butterfly long condor really amazing comes down to the most important option factors for pricing of options in general. So when we're looking at an option price, it's made up of the key components are the time decay and then implied volatility. All right, so the big component though is this time component, so which we call theta. So when we look at the profit generation that we can get from a butterfly or condor, it comes down to understanding how time decay affects the price of your option and how that affects your price of your option all the way up to expiration. So when we look at theta, that's the time decay component that we can measure, time decay by the Greeks. It tells us how much an option price will go down over time. And this is the rate of your time decay of your stock option. So this occurs because that extrinsic value or time value diminishes and goes down as expiration draws near and eventually goes to zero at expiration. So it's kind of like a coupon that you might get at a store. You look at the redemption date and you've got till such and such date. And if you don't use it, then it expires worthless. And that's exactly how an option is. So when we look at the different constructions here, we've got the butterfly, and I also lump in the long condor because it's so similar, but we could spread the short strikes out of the spread. So when we look at this, here's an example to show you how you can get your risk so low. Now this is XYZ, okay, and it's trading at $45. Now we're looking for a downside move to 43. And so what I like to do is before you ever put a trade on, you should always have a kind of a price target. Where do you think it's going to go? So I call that kind of a price target. And I'll use Fibonacci or support resistance based on moving averages. So get an idea of target, and then that is where we're going to set kind of our price point for a butterfly. So in this example, it's 45, and we're looking for just a small move down to 43. So what we can do here is we can go out, we could buy the June 44 put. We pay $2.38. All right, so that'd be $238 for one contract. And then we're going to sell the June 43 put below it, and we're going to bring in $1.67 credit. Now we're going to sell another 43 put at $1.67 credit again, and then below that buy the 42. So we've just here constructed a butterfly. Now the butterfly gets its name from the body, which is where you have your short strikes, and that's our target. So that 43 June put, that's our short strike that we're targeting right here. And so this, when we go through the math of it, you can see you can develop or construct these for very low risk. So the 238 for the debit cost of that 44 put, the $1.06 for the debit cost of the 42 put, less the credit you brought in from selling the 243 puts of $1.67 times 100 to convert it to an option. So in this example, you've got a total risk on one spread of $10. All right, so if everything backfired on you and the market went against you, the most you could lose on this setup would be $10. Now the profit is you just take your middle strike, in this example 43 less the strike below it 42, and you can see that's like $1. So that's the spread width. We call that the spread width, and that would be $100. So 43 minus 42 less the cost of the trade, which is your total risk, that debit cost, and that would put your potential, what I call theoretical profit, at 90 cents or $90 per option contract. So in this example, you can see that theoretically you can make $90 on your risk of 10. So that's a 900% return, or 9 to 1. So you're risking $1 to make 9. And the reason I say theoretical, because on a butterfly, you'll never make the exact potential profit or theoretical profit, because it's just nearly impossible for it to go out at expiration right on that short strike 43. But that's going to be very close. So just think about it. If you can make something at 900%, you'd be pretty happy with 100% or 200, right? Now let's take a look at the different butterflies and condors. I call this kind of the butterfly family. And when you're looking at option strategies, to me, my opinion is that the goal of every trader out there really should be, you should look to select your trades based on what's going to provide you the most consistent positive return. And for me, with low defined risk and not always that great home run type return. So it's really comes down to hitting singles and doubles, and then eventually you're going to hit some triples or home runs. So if you just stick in the game, keeping your risk real low, but with these butterfly structures, you can really hit the home run off of it as well. And one of the best ways then to achieve this, about what option strategy to use, is to be aware of the different option strategies that are out there available to you, understand how they work, and then select the one that's going to be best suited for the market environment you're trading and your specific trading goals. So everybody here will have a different amount of capital in your account that you can trade. So Charlie might have a $100,000 trading account and Barbara has 10,000. So it's going to make a difference on your risk that you take. But one thing you'll find is that with the butterfly, you can trade it with a large account or small account. It doesn't matter. And these are really great strategies to be successful with. The first time I really saw a butterfly in action, I'd set up an over-the-counter brokerage company, oil brokerage company for a company. It's called PVM London. They were the largest oil brokerage company in the world. And we were doing a option butterfly for a hedge fund. They were doing 24,000 contract butterfly on crude. And so it was pretty amazing. I mean, that was a huge position. But the point is, you can do it with, one contract to 25,000 contracts. It doesn't make any difference. So the small guys like us can use the butterfly just as much as the hedge funds. And when we look at the butterflies, there are a lot of different variations of the butterflies. So we've got what I call it kind of the butterfly family. We've got a long butterfly that we can use calls or puts. We've got what we call a broken wing butterfly, or you can call it a skip strike, sometimes called that. We can use calls and puts for that. We've got what I call the ninja butterfly. It's basically an unbalanced ratio butterfly. We've got a wide wing directional butterfly. Then we've got the iron butterfly. And then there's a whole nother category, hedging, okay, defending various different types of trade setups, credit spreads or debit spreads, or just long calls or long puts by converting to butterflies. And then we've got another kind of offshoot of that, the long condor option spread. Now let's take a look at a bunch of these trades so you can get a better idea of how these work. So I've got a lot of different examples here I'll show you. Now the first one, we'll look at just the balanced butterfly trade itself. And when we look at butterfly spreads, we can adjust the risk and the potential profit based on what we call the wingspan of the butterfly. So, kind of think about, if I get my drawing tool, if you're out there trying to catch a butterfly or something and you have a net, it might be easier to catch the butterfly if you have a big net, right? Versus a small little net. So with the butterfly, we can kind of have that concept. We can make the butterfly really a wide wing butterfly to give us a bigger profit zone or bigger net, or we can narrow the butterfly to make it reduce our risk, but we're going to have a smaller profit zone. So let's take a look at these different types of setups. So the first one is a narrow wing butterfly. Okay, so this is going to be like a spread width of $1, which would be $100 per option spread or contract. And this is on SPY. So the ETFs and the index options like the SPX, NDX are great for butterflies. SPY is great for butterflies. The Russell IWM, QQQ, these are all really great for butterflies. And so I always like to look at the directional side first. And so here we have a kind of my Fibonacci levels from a high to low. I've got this 618 retracements, my target. to around 273, 274. And there's also a lot of option activity. I like to look at the option activity and see if there's kind of what I call unusual option activity. So this gave us a great target to 273. At that point in time, it's trading down here about 265. But we want to keep the risk real low because the market, had a move and we're, worried that it could turn back over. So what we did was a narrow butterfly. So these can also be very short duration trades. You can put this on for 1 day to expiration or 7 or 8 days or longer. But this was set up on like the 14th and expiration was 2 days later. So it was trading at 267. We were targeting 273 based on that Fibonacci level and some option activity. So bought the 272 call, sold the 273, sold the 273 again, bought the 274. So if you break that down, you've got basically a call debit spread 270, 273, and bear call credit spread 273, 74. Now, this is the beauty of it. Spread width then is $1. Okay, if you take, you look between the different strikes, that's $1 wide strikes between. And so that's $100. And your cost of the trade was 10 cents right here where my pointer is, or $10 per option contract. So theoretically, you take that spread width less the cost of the trade, 10, that would put you into profit of $90 if it went out exactly at 273 at expiration on that Friday. And that would be a 900% return. But, when you put the butterflies on, you're never expecting to get that max, but, you can get close. And on this one, 2 days later, it was up $70 per butterfly spread. And on a risk of $10, that's a 700% return. So literally this is the only trading strategy there is where you can get returns of over 1,000%. All right, so here's what it looks like on the risk profile going out at expiration. And it was trading right here about 273.08, pretty close, but not close enough for that max profit. So you can see it went from a 10-cent debit here to 80-cent debit. So $10 to $80, that's $70 per spread. And that's your return of 700. So in this one, it was just, 2 spreads. It's over $280. But the beauty of it is that, if you do 10 spreads, you're risking $1,000. And if you do, 1 spread, or $100, excuse me, and you're risking 1 spread, you're risking 10. So you can get your risk reward super low. And these are, sometimes I call these kind of a lotto trade too, because if we want to take a high risk trade, we can do it for very cheap and we can get potentially a big payoff. So that's a narrow wing butterfly. Now here's one on Tesla. And the other great thing with this strategy is you can trade the really high price stocks for very little capital out of your pocket. And again, these are debit cost trades. So your risk is the debit paid. So here's a wide wing butterfly on Tesla. And so this is $1,000 wide spread, big net, all right? So this example, this was earlier this month, Tesla was trading at 933.50. And we were looking for a target up to 1,000, just kind of like that even number 1,000. But, with Tesla, it can be a really crazy, hard moving stock up or down. So we wanted to keep the risk super low. So we did this with the butterfly. So what we did was this was set up on the 8th, and then expiration was going to be on the 12th. Now we were targeting $1,000, and at that point in time it was trading at 933.50. So we set the body at $1,000. So what we did, we bought the 990 call, sold the 1,000 call. So you can see that's $10 wide. And then we sold the 1,000 call again, bought the 1,010 call above it. So call debit spread, bear call credit spread, balance. So each between the strikes is $10. So that would be per one contract, option contract, that's $1,000. But look at the cost of the trade, $32, 32 cents. All right. So you're looking at a stock that's trading at, say, $933. That's, if you'd bought 100 shares of that, that's $93,000, right? But on this one, we're controlling, an option contract, which is equivalent to 100 shares for $32. That is, insane. So for example, here, if it went to $1,000, what's your return on your stock? So if we take $1,000 minus your cost, if you bought the stock for $933.50, you would make $66, and your underlying risk was $933, so you make about 7%. All right, so here you can make 7%, but your risk is huge, and your capital outlay is huge. But look here, this is your potential theoretical profit. If you have a $1,000 spread width, 32 is your cost, theoretically, you could make $968 if it went out right at your short strike at expiration, and that would be a 3,025% return. All right, so it's just like I said, it's the only strategy there is that can give you this type of payoff. Now, we were looking for just a move up, and just it exploded to the upside and went past our peak area here. So we went ahead and took profit, but still it was a decent profit, and especially based on the risk of 32. So this was trading at 1,008 right here. And so we closed out that trade. And so that was, at that point in time, it was up $138 per spread. So if you did one spread, your risk was $32. Your profit here would be 138, or if you did 10, you can do the math on that. So that was $106 profit when the spread was trading at 138, 106 profit on your risk of 32. That's a 331% return. Now, it's also a low stress trade, in my opinion, when you're risking 32 versus if you bought 100 shares and you added $93,000 out there, that's a pretty high risk, and that makes you a little bit edgy on that. So that's a great example of how you can incorporate this strategy for trading really high price stocks as well. Now, here's another one. This is on Apple. So this is a directional wide wing butterfly, and this one was set for a $500 wide spread. All right, another directional trade, and we were looking for a move up here to this Fibonacci level, coming in right about this 618 level. So we were targeting right up to about this 280 level right here. We had some moving average price action right here, and so we were trading up here, and there was a lot of option activity at the 280 strike. So it was trading at 270. We were targeting 280. We wanted to keep it very low risk, so we did a butterfly. So this was set up on the 13th. Expiration was the 17th, so fairly short duration trade. And we did then bought the 275 call, sold the 280. So $5 wide call spread there, and then sold the 280, bought the 285. Okay, and again, $5. All right, so $500 your spread with. Now the cost of this trade was $87. Okay, so that's your maximum risk would be $87. And your potential, what I call theoretical profit, then is the difference there, 413 per spread, which would be a 475% return. So basically, you're risking $1 to make $4.75. So the risk reward on these are very, very good. Now, this went out trading right here. It was going out right in here. See, that purple area is what we call, that's where it is in time. And the teal area is actually the profile of that trade and what it's doing at expiration. So right here, that morning on the 17th, it was trading right there at 279.23, right where that arrow is. And so that was a profit of, it was up $223 per spread. So it went from where my pointer is 87-cent debit, that spread blew out to 310, and there's a $223 per spread profit there. And that on your risk of 87 is a 256% return. So, one contract or 10 or whatever, you can see what the potential payoff is based on the size of account that you'd like to trade. But the real key for me, again, is going back to see how small and controlled your risk is. Now, here's another example. This is a directional short trade, and this is on the ETF SPY. So SPY is a really great vehicle for these because it's very liquid, and you can get very good liquidity. And the other great thing with the ETFs is you have dollar-wide strikes, so you can do a lot of different variations. So here's a wide wing butterfly set up on SPY, so $300 wide spread. And so SPY was trading up here. We were looking for it to roll back over, and we wanted to do a short trade. And it's been hard to short this market, because you'll get a sell-off, and then you'll get a knee-jerk, back up usually the next day. So we wanted to keep the risk really low. And when we hit our target, that's when we want to take our profit, even if it's not expiration. So with options, you'll never get your max profit until expiration, but you have to, when you trade options, you have a target, you hit your target, you still take your profits. All right, so you might be getting singles and doubles, but then if you get into expiration, you might get that home run. So here we were targeting this 382 retracement at 332 right here. And so our trading model that I use is based on momentum. So that was giving us a short sell. So we wanted a very structured trade here to find risk. So it's trading at 336.40, and we were targeting 332, that fib level. So we bought the 335 put and sold the target, the 332 put, All right, so sold at 332, put again and bought the 329. So put debit spread and bull put credit spread. So we created this butterfly spread here. And we had a spread width here of $300, okay? And so the risk, though, was 35 cents or $35. So the difference would be our potential theoretical profit of 265 at expiration. So not a bad return. That'd be 757% return. Now, 3 days later, this was trading, and we were up 156 per spread, which is still a fantastic return on your risk. So here it was trading coming into expiration, and it was trading right here on that purple line right there. So not your max profit. See all that black area? That's what's still left of potential profit from the time theta that's still in the option spread and volatility. So if you could have waited and it went out exactly there at 232, right at the last second of the day, you might have been able to scrape out, pull out that additional profit. But that was good enough. So it was trading at 332.68. So this went from, that spread of $35, and now we took this off and it was trading at 332.60. So we had a profit of $156 per spread, and that on that risk of 35 was 445% return. So you can see down below, you can see that the put debit spread was set up. The 335.32 cost, that part of the spread structure cost $77, and at expiration that was going up at $213. And then the put credit spread was set up. That part of the trade was at $42 credit and bought back at $22 going out. So, this is two different spreads together. You've got a long spread with a short spread, and that's the beauty of it, because you get that theta decay. See the theta on here? $41 per spread. So you get the time decay is what we call positive theta. It's going in your pocket each and every day. Now, here's a really interesting one. This was on Amazon. And again, Amazon is like Tesla. It is just can be a beast, right? But it's also very, very expensive. So it's very hard to trade unless you have a huge account. So this was doing an Amazon trade, though, for very low at risk based on using a butterfly. So Amazon was trading at about 1782 right here. So it had come off this support area here. This was a 200-day moving average. So it was building really good support, but it also had good resistance right here at this 1830 level. So we wanted to set up a kind of a target trade just to 1830, but we wanted to keep it really low risk. So it was at that point in time trading 1782. So we set up a butterfly with the target to 1830. All right, so bought the 1820 call, sold the 1830. That was our target. So that's $10 wide spread, right? And then sold the 1830, bought the 1840, $10 wide. So bounce butterfly. So one spread would be $1,000 on the spread width. The cost of the trade was $80. Okay, so look down here. So 80-cent debit. So that was the maximum risk per spread. So if you did one spread, it was 80. If you did 10, that's $800. But again, here you're playing a stock. At that point in time, it was trading at $1,782. So think about that. If you bought 100 shares, you're paying you've got $178,000 out of pocket. But by doing a butterfly, we had $80, per 100 shares out of pocket. So one contract, 100 shares, $80 versus 178,000. Now here you can see the potential theoretical profit would be $920, which would be 1,150% return. All right, so incredible. But if we could get any piece of that, you'll be happy. So here's how this goes out. So this is the other incredible thing about the butterfly. So this was on the day of expiration, the 6th. This was in the morning about 9:30, 10 or so. And at that point in time, it was trading right here at that purple line. See all that black area? That's still what's potentially left of profit for that one day until expiration, the one day until 3 o'clock. So at that point there, it was trading at 1836, all right? And at that point, this trade was up $150 per spread profit, all right? So $80 was the spread cost, and now it was up to $150, which per spread profit, which is still a great return. That's 187% return on your risk of $80, okay? So right here. Now, look what happens just about 3 hours later or 4 hours later as we're going into the close that day. All right, so look, this goes from 150 and it goes 4 times more in value. And that's just, and actually it's trading at 1832. So it's gone closer to that short strike. But the big thing is giving you the payoff is the volatility, and the time decay is being stripped out of it. So with options, the price is made up of time and volatility, and at expiration, those two go to zero. So the short component of this is sucking out that time decay and volatility. And so this went from a $150 per spread profit, and 3 hours later, it was $614 per spread, or a 4 times your return on capital. So now it was up to 769% return versus earlier that morning, 187. And again, you're risking $80 versus, 178,000. So it really is kind of an amazing structure when you think about, what you're doing. Now, and this is a positive theta type structure that I like too, because if you trade a lot of options, you understand the theta decay and how that can really eat your profits up, right? So if you're long calls or long puts or debit spreads or whatever, if the market goes sideways and sits on you, you're losing money. So I love this from the standpoint of getting that positive theta. Now here's a really interesting one. This is what we call the Batman butterfly. This is one we set up last week on Microsoft. All right, so this is what we call kind of a directional pinning trade, where you're looking at, the market to go out and what we call pinning, go out at a certain strike at expiration. So this was set up for last week, the monthly expiration. Now, what the Batman is when you're not sure about direction, we can do 2 butterflies and it kind of looks like a Batman. So in this example, we were looking at, this was on the 12th, and we were looking at Microsoft was trading right here about 187. Now we were looking at potentially where could it go out with the monthly expiration. So, we're looking at the option activity and things like that. We looked at the 200 strike was the upside target, and the downside target was 180. All right. So we were stuck right in the middle of the range. So did not know if it'd go up to 200 or down to 180, but we thought, okay, the good probability it would go to one or the other. So how can we trade this? So we did this as a Batman butterfly. All right. So it looks like the bat ears right there. So the first trade was targeting butterfly 1 was targeting down here to the 180 strike right there. Okay. And then butterfly 2, we set that up too. That was targeting to the 200 strike. Okay. So we had a butterfly targeting 180, butterfly targeting 200. So we had a butterfly 1 was doing a put butterfly, and they were both $2.50 wide. So 182 and a half, 180, 177. So that one was right here. Okay. And that cost, look at the cost of that, $15. That's your maximum risk. And the potential maximum profit would be 235. Now, so these are cheap. So we thought, okay, well, let's target 200. So then we put one on for 200. And so this was the 197.5, 200, 202.5. And that was 17 cents. Some of the members got this on for 15. So they had $30 of risk. All right. So you look at this, then your maximum cost is the spread, the butterfly on the targeting 180 of 15, and then 17 targeting the 200. So maximum potential risk, if you did one spread, which means both butterflies, all you could lose is $32. Now, the only way you'd lose this is if it went out between or above or below. But, with the option analytics that we do and use, they gave us a good probability for 200 or 180. So this was going out on the 19th. It was up at 198.95, right there at 199. And so this was up $63 per spread. So the butterfly was making the max profit here on this 200 butterfly. This was a total loss, but only a loss of 15. So taking out the loss of 15, the profit on the butterfly here at 94, less your one, here you're losing 14, here you're at 94, so you're making it there. So that's, your profit of 63, which on that risk of 32, that's 97% return. So here's what it looks like, a little bit better picture of it. So going out right here, so the butterfly that targeting 200 was at 17. So that was going out at $94. Okay, so there's your profit there. And then the butterfly that you had on here targeting 180, you had a cost of 15, and that was at $1. So you're losing 14 there. So your profit is 63. So that's if you did one butterfly spread, it'd be 63. If you did 10, that's 630. But your return is still a really nice return of 197. Now, the next thing we'll do is the long condor spread. Okay. So this is one that I like too. And I really like this one for when we're structuring and hedging. So usually I go to this one first for a hedge. And then if I need to, I could, kind of adjust down the trade and I could turn it into butterfly if I wanted to. But it's a good structure because what it can do is it can give you that positive theta. It's going to offer you, again, very low capital at risk and a really high return on your capital. And this is a great structure for hedging. Now, the condor kind of looks like this. It's very similar to the butterfly, but we're not sharing the same short strike of the two spreads. So here would be, you could do call debit spread, and then here's your bear call credit spread, or you could do puts. You could do either way, puts or calls, depending on the direction you're trying to go. Now, here's an example of a long condor, and this was a defensive hedge set up on SPY. All right, so the ETF. Now with this trade, we were looking for a trade to the downside, and we had SPY was trading right here, right about this 276 area right in here, okay, 275, and we were looking for a break of this level, okay, based on our indicators, momentum, etc. And so again, our target was based on Fibonacci, the 618 retracement down to 270. So the way I look at these trades or any trades is if you hit your target, you start taking profit. Now, if you have one contract, you take it off. If you have 10, though, you start scaling out, things like that. But you take your profit because it could easily bounce back up. You can see how it did bounce back up here a few days later. But a lot of times the market was bouncing up the next day. So you take your profit here. And trading, a lot of times you can also think of trading like it's kind of like a chess game. You need as a trader to be thinking 2 or 3 steps ahead. So I always look at it, okay, so if it hits my target, what can I do? Well, I know I could take profit, okay, but could I do something else? Could I enhance the trade? Could I adjust the trade to make it even more profitable? So I'm always thinking of other things I can do. So in this one, we thought, okay, what we could do is if it breaks down here, when it's trading right here at this 270, instead of taking max profit or taking all the profit off on the debit spread that I'll show you, we could convert this to either a butterfly or condor and stay in the trade for a longer period of time and maybe inch out or squeeze out some more profit. All right, so the original trade was just to put debit spread, the 270 through 270. And so really nice low risk trade, $65 risk. So $3 wide or $300 minus your cost. So potential for trade at expiration of $235. Nice return, 361, but the markets have been bouncing back up. So when this hit down to that target of 270, we went ahead and took partial profit, which was 98 per spread. Okay, so it went here and it was trading right there at 271.34 right there. So this was up $98, profit per spread. So it went from 65 to 163. So took some of that off. Now that's still a pretty decent return. But instead of taking the full trade and closing it out, what we did was when it blasted down here to that 270, it was trading 270 right here. We were able to sell a bull put credit spread, the 268 put short, and bought the 265 below it and brought in a $65 credit. All right, so look at that. So that brought in a $65 credit. Now, when you put the two together, look what happened. We had a $65 debit cost of the original put debit spread, but with it, when it fell down, we were able to sell the 268.65 bull put credit spread for 65 credit. Now we have zero risk. And on this trade, some of our members got in for even a credit on the full trade because this was down to, at one point, I remember it was about $1 credit. So what you've done here is you've made what we call a free trade. You have zero risk in the trade. Then you can sit back and see what it does. And theoretically, potentially, if this goes out between the short strikes where my pointer is, the max profit would have been $300 on zero risk. But it went out right here. So close that out. And that was up $164. But on zero risk. Okay, so that's kind of like an infinite return. So if you look and break it down, trade one was okay, $98, 150% return. But by doing that adjustment for a free trade, we were able to squeeze out even more money, 2 times more basically, and make 164, but also on zero risk. So if you wanted to sit back and do nothing and wait, you had nothing to risk. And to me, that's what it's all about. So there's just so many great ways to use options, and I wanted to pass and share some of these strategies with you today. So if you'd like to learn more on how to master these really high reward, low risk strategies that work in any market environment, there are 2 things you can do. You can learn a lot from hopefully what I showed you today. But if you'd like to learn even more, I've got an on-demand course that I did just recently, about a month ago. And so for this link here, if you can put that in, you can, if you have the link, I don't know, hopefully you do. Anyway, the link is, if that's the link that she's sharing. So it's basically powercycletrading.com/FLYJV. So if you put that in, you're going to get this full course, on-demand course that I did. This was 2 months back. So it's a really new course, and it's all recorded, broken down in 30-minute modules or less. And for you today, it's only $97. So for this, you're going to get the full course and all the PowerPoint, which is a 437-page PowerPoint. And then you get all the modules of the video modules of the course. This is yours forever. So, when you buy it, it's yours. You'll get a login to your own kind of vault on our website. So it's on the cloud. So you'll get the on-demand course that you can access, from wherever. And then we'll do a live follow-up Q&A probably a week from now. So you'll get a link for that, when that's going to be, and you'll get a link to that. And then I'm also going to give you also my other recorded on-demand course, Option Beginners Program. This is a nice beginners option trading program or course that I think would be good for your trading library if you'd like. And then also bonus 2, you'll get my option trading tutorial. This is a 60-page option guide with videos on the Greeks and option pricing. I'm also going to give you my option strategy manifesto. So this is 15 other really cool option strategies. So a guide for those, how to use them. And then my power tool guide. This is the Greeks, gives you, you can print it out on your desktop and have this at your fingertips on, what's delta, theta, gamma. Plus, I'm going to give you a 30-day trial to my trading club. And if you then decide to stay on, it's $97 a month, or you can do an annual membership for $488. So you'll get 30 days trial, and you can start whenever you want. Just let us know by email if you want to start it a week from now or 2 weeks, but you'll get this for 30 days. So let's go through all the bonuses here, or what's in the course. First off, part 1, I always like to start off with the Greeks that are vital to making you successful with these types of trades. So the Greeks that really affect the butterfly, long condor. The big one is the theta decay and how that impacts these two strategies. And then volatility is very important, the importance of what we call volatility crush for structuring the butterfly and the long condor. And then to explain in detail option pricing. So you do this course, it's going to help all your option trading, because you'll really understand option pricing after we go through this course with you. And then the other really big component is to understand standard deviation. And this is what we use for forecasting price direction. So a detail in the course on how to use that. So you'll be up to speed, and you'll be very comfortable on what standard deviation is and how to use it to forecast price direction based on options. And then part 2, we go into the core basics of these two structures, the butterfly and condors, that most traders just don't understand. So you'll get all that. And then we go into the foundation of these two spreads, which is basically made up of vertical spreads. And then we go through each butterfly, each different variation. So how, why, when to use the long collar put butterfly, to use the wide wing butterfly, to use a broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So it's like Bubba Gum shrimp, but we're going to cover, and this course covers every variation of the butterfly. So you'll really be up to speed on which one to use and when. And then what are the best time frames? When do you put these on? 2 weeks out, 3 weeks out, 2 days out. Okay. And the best trading vehicles, what ETFs and indexes. And then how do you get those structures of 10 to 1 or higher? So teach you how to do that and how to look for it, how to narrow your spreads, how to do that spread width, and then how to profit from volatility collapse and theta decay using the butterfly. And here's another whole kind of section or chapter here in the course is how to use what we call monthly option expiration or pinning. So, 12 months a year, we have the monthly expiration. So you've got potential 12 times a year to make some additional income off what we call option pinning. So take you through what that is, how to use it, how to set up butterflies for that, and then how to target your targets based on Fibonacci and also option activity. So that's also covered in the course. And then we go into the long condor. So the major trading advantages of the long condor option spread, which is combining the vertical debits and credit spreads together. And these are, a structure that can provide 100, 200, 300%, returns on very low capital at risk, and give you, again, positive theta. And then how, why, and when to use the Condor spread in your directional trading. So it's going to give you that defined risk, low risk, and great for directional trades and great for hedging. And then a big part of the course, we spent probably the majority of the time on hedging. It's so important for you to understand how to hedge your positions. And these are, like I said earlier, these are the two best strategies for hedging. So we spent a good amount of the course on how to manage your trades using the butterfly and long condor hedge to hedge core positions and to hedge debit spreads or credit spreads. So it's a really thorough course. It's about a 7-hour course all in total, or maybe longer. We also cover what is assignment risk, expiration, auto exercise, and you get a trading library of a lot of different butterflies and condors. So for $97, you're going to get one of the best courses you've ever, probably have taken ever in any of your trading. So here's a little feedback from a few members that took it. So excellent class, Larry, as usual. You under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money doing credit spreads. That is so common and typical for any trader, really. Thanks again for showing so many ways of getting out of trouble. And that's the other one I like, getting out of trouble, right? You can get in a lot of trouble in trading, but these can get you out of trouble. So it could have come in handy in the past, and my trading P&L would have been totally different, Jim. Besides being profitable, you can tell your audience that your courses are right on point and you are an expert among experts. Using your alerts was instrumental also in learning more about options, and that was from Dan. So here are your enrollment bonuses. And again, use that link there, powercycletrading.com/flyjv. So we'll do a follow-up Q&A. So we'll send you out a link to that. And this will also be recorded. You get my option trading tutorial, so 60-page option guide on the Greeks and option pricing with videos that go along with that. And then you get my beginner's home study package. So this is a 4-hour course on easy to understand kind of course on options with some simple to use option strategies. Goes through how to develop a trading plan, basics of options, how options work, types of options, monthly, weekly, leaps, account, trading levels, and much more. So this is a really nice complementary course too if you're just starting out with options. And then you get my 15 option strategy guide, so that you can print this out, put it on your desktop. It gives you the option structures, risk reward profile, things like the back ratio, spreads, straddles, strangles, a lot of different option strategies there to get you familiar with those. Then my option guide here, so it gives you the Greeks right at your fingertips. And then you'll get a trial monthly membership to my trading club. And then if you stay on, it's $97 a month, or you can do an annual membership. And again, you can start that whenever you like. Just send us an email. But with the trading club, you get access to my virtual trading room each and every day. I'm in there 9:30 to 10:30, and then back for the close. And then you're also provided a daily market update video after the market close. All the videos are archived for your review. Access to our weekly Q&As every Tuesday, live and then recorded. Traders Educational Vault, and 60% discounts on all courses and trading software on my website. So it's a very thorough package here, and I hope you can take advantage of it. So here's everything here, and use that link. Yeah, with the SPY trade that I showed you, not the Batman. I'm not sure which trade you're talking about, but yeah, the Batman had a total risk of those 2 debit costs, and that was $32. So again, you're going to get access to the 6-hour trading course. It's actually about 7 hours or so, live follow-up Q&A, options beginners course, and all that good stuff there for you.
Outstanding, Larry. What a terrific presentation. There are a few questions that came in here that I noted that I'd like to share with you.
Okay.
Early on in the presentation, there was an observation made from a couple of folks saying, aren't balanced butterflies low probability trade? Low chance of stock going to the short strike near expiration. Do you use some kind of a directional indicator to increase those probabilities?
Yeah, I definitely use directional indicators. So my whole trading is based on price direction and then options to execute the trade. So one thing, again,
Right.
I mentioned earlier, so basically I use my trading model here, so you can kind of look here. If there's something you'd like to look at, we can pull it up. But yeah, so I use my trading model to give me price directions based on price momentum and some other indicator tools. But the other thing too, remember I talked about spread width and the butterfly, the
Right.
width of the spread. So the wider you make your butterfly, like a big butterfly net trying to catch a butterfly, the easier it is to hit your profit. So if you're, for example, here, we're looking for a target down here on Medtronics to 86. So if you do a butterfly here, you could do like a $5 wide butterfly. You could buy the 90 and you could target the 86, or you could buy the 90, target the 85. So you'd have a $5 butterfly spread, and that's going to give you a pretty big wide net. Or you might be able to do a $10 wide. So the wider you do your net, the easier it is to hit your profit. You don't have to be perfect on hitting that profit target. Okay. So
Okay.
that's also pretty much really important. Great question. That's really laid out in the course.
Well, and it's interesting, you're showing your screens right here. One of the questions that just popped up is, how do people get access to the power cycle indicators? Is this something that's packaged up on Thinkorswim or?
Yeah, these are my proprietary indicators. So if you join the club, you can then go to you'll get a 60% discount on everything. You'll get a discount under the membership area. So if you join
Okay.
our club, and then you'll get, once you are a member to our club, you go to Power Cycle Trading, you'll get your discount coupon number, to give you 60% off. If you want the software, you just click on software and buy whatever you want. We've got the volatility scanner, my custom indicators, my multi-time frame. This is my newest indicator. This is a really great indicator. Momentum indicators, opening range indicators, momentum flow signal trigger indicators, cycle reversal indicator. So you can get all this at the, say, for example, the retail price here, if you came in off the streets and you wanted to buy my scanner or something, this scans for a volatility breakout, it's $397. But if you're a member, you just come in here and you put your 60% off and you get 60% off. You put your code link in there and this will be knocked off and you'll get that down at, $198 or something like that, or
That's great.
178.
And as you were scrolling through there, you can see, folks, that I think Thinkorswim is a very popular platform, but there are indicators that are programmed on some of the other platforms there as
Yeah.
well.
So for the core trading model, we have and you get, if you buy it, you get it for all the platforms we have. So this one you get for
I'm just waiting on this guy to finish up. I got to start in a minute or two. How did it go?
Thinkorswim, Ninja Trader, eSignal, and TradeStation. So you get one
Okay.
or all for the one price. Yours
Okay.
forever.
Man, that's fantastic. And let's see, there's some other questions here. Let me see. How many days to expiration are these trades entered at? Was the question that came in.
Yeah, I like to do what we call swing trades. So I like to look at trades usually 7 to 8 days out. And we could even look at, a lot of times we can look at trades 2 to 3 days out. So, I'll look at it, we come in Monday, I'll be looking for a trade that might expire Monday or Tuesday. Like this week, I'd be looking for trades that might expire this Friday or the week after.
Okay.
So kind of my time frame is anywhere from 3 to 4 days to, 8 days, something like that. So fairly short term, but we can go longer term as well. But I like to keep it fairly short duration because, when you're in a crazy market environment, the less time you're in a trade, that reduces your risk.
Absolutely. Yeah, it's like the jungle. The least amount of time you have to spend there, the lower the possibility of getting eaten or having something
Time
bad
equals
happen
risk.
to you. Exactly. Larry, thank you so much for coming and being with us this afternoon and for sharing this very, very thorough presentation on butterflies, how you use them, why they're one of the popular strategies that you like to use, and for putting together this special offer that you've made available for those that are joining us here today.
Thank you again. Everybody, good luck trading.
Thank you.
All right. Thank you, Larry. And once again, folks, Larry did a great job here. Special offer for the Butterfly Long Corner Option Master Course that he's put together. There's a couple of links that are out there. You can also use Westmark Trading /Power Cycle, and we'll link back to that special offer as well. And another question has come up that I should have reminded people of. All these presentations are being recorded and they are going to be sent to you this weekend. In addition to that, all the special offers, contact information, things of that nature. We're going to bundle that all up so that you have all of that available to you. So no worries if you missed a special offer, you forgot to write something down, it's all going to be packaged up and sent to you this weekend.